Hello, everyone, and welcome. Today, we are talking about something every construction business owner wants, but many struggle to achieve consistently: financial success. You may have a full project schedule, your crews may be busy, your trucks may be moving from one job site to another, you may even be generating more revenue than ever before. But at the end of the month, you may still find yourself asking, where did all the money go? Why does the business look profitable but the bank account still feel tight? And what do I need to do to change to build a financially secure construction company? Today, I'm going to share a practical roadmap that can help you answer those questions and move your construction business together toward great profitability, stronger cash flow, and long-term financial stability. Let me begin with a common situation. Imagine a construction company generating $2 million in annual revenue. The owner is working long hours, the crews are busy, new projects are coming in. From the outside, the company appears successful, but the owner is constantly worried about payroll, material bills, equipment payments, subcontractor invoices, and taxes. The company is busy, but the owner does not feel financially successful. Why? Because revenue alone does not create financial success. A construction business can generate millions of dollars in sales and still experience financial stress if projects are underpriced, expenses are not controlled, change orders are not billed, or cash is collected too slowly. True financial success comes from understanding what happens to every dollar after it enters the business. The first step in building a financial roadmap is understanding where your business stands today. Before making decisions about growth, hiring, equipment, or expansion, we need to examine the financial foundation of the company. A comprehensive financial assessment may include reviewing your income statement, your balance sheet, your cash flow, your accounts receivable, accounts payable, job profitability, overhead expenses, debt obligations, your tax liabilities. We also examine whether the financial reports are accurate. If personal expenses are mixed with business expenses, transactions are miscategorized, accounts are not reconciled, or project costs are missing, the reports may not tell the true story. You cannot build a reliable financial roadmap using unreliable numbers. During the financial assessment, we look for warning signs that may be quietly affecting the business. For example, is revenue increasing while profit is decreasing? Are labor costs consistently higher than estimated? Are material purchases being assigned to the correct projects? Are customers taking 60 or 90 days to pay? Are subcontractor invoices being recorded promptly? Are change orders approved and billed? Is the company paying for equipment that is rarely used? Are overhead expenses growing faster than revenue? These warning signs may not seem serious individually, but together they can reduce profitability by tens of thousands of dollars each year. The purpose of the assessment is not to criticize the business owner. It is to identify opportunities for improvement before small financial problems become major financial problems. Once we understand the current financial position, the next step is setting clear goals. Many business owners say, I want to make more money, but that is not a complete financial goal. A measurable goal might be increase gross profit margin from 25% to 30%, reduce accounts receivable collection time from 60 days to 35 days, build a cash reserve equal to 3 months of operating expenses, reduce unnecessary overhead by $3,000 per month, increase average project profitability by 5%, pay down $100,000 of business debt over the next 18 months. Clear goals give the owner and the financial team something specific to work toward. When there is no financial target, it becomes difficult to know whether the business is actually improving. One of the biggest financial challenges in construction is understanding true profitability. Your income statement may show an overall profit, but that does not tell you which projects are producing that profit. One project may generate a healthy margin while another project quietly loses money. For example, imagine you complete two projects. Project A generates half a million in revenue and produces $100,000 gross profit. Project B also generates half a million in revenue but produces only $25,000 gross profit. The revenue is the same, but the financial result is very different. Without accurate job costing, both projects may appear successful simply because the customer paid the invoice. Your financial roadmap must identify which types of projects, customers, and services are producing the strongest results. Accurate job costing is one of the most important tools for construction business owners. Every project should track the major cost categories, including labor, materials, subcontractors, equipment, permits, insurance, direct project expenses, and allocated overhead when appropriate. You should be able to compare the original estimate with the actual project results. If labor was estimated at $80,000 but the actual labor cost was $105,000, we need to understand why. Was the original estimate too low? Did the project experience delays? Was the excessive overtime? Was work performed outside the original scope? Did the crew require additional supervision? This information improves future estimates and helps prevent the same financial mistake from happening again. Sometimes a construction business does not have an expense problem, it has a pricing problem. If projects are priced using outdated labor rates, old material cost, or unrealistic production assumptions, the company may lose money before the project even begins. Suppose your material cost increased by 8% and your labor cost increased by 6%, but your pricing remains unchanged. Your profit margin will continue to shrink. A CFO level review examines whether your pricing includes current labor cost, payroll taxes, workers' compensation, insurance, material increases, equipment usage, project management time, administrative overhead, contingencies, and the desired profit margin. The goal is not simply to win more projects, the goal is to win the right projects at the right price. Profit and cash flows are connected, but they are not the same. You may complete a profitable project today, but if the customer does not pay for 60 days, you may still struggle to meet payroll next week. Construction companies often pay for labor, materials, equipment, and subcontractors before receiving full payment from the customer. This creates a cash flow gap. Your financial roadmap should include a clear billing and collection strategy. That may involve requesting deposits before work begins, using progress billing, billing immediately when milestones are completed, following up on unpaid invoices consistently, negotiating better payment terms with suppliers, maintaining a cash reserve, and forecasting upcoming cash requirements. A company should not discover a cash shortage only when payroll is due. Cash flow should be reviewed and planned in advance. Change orders are another major source of lost profit. A customer asks for an additional feature. A project manager approves extra work verbally. The crew completes the work, but the change order is never documented or billed. The company pays for the labor and materials while the customer receives the additional work without paying for it. Even small unbilled changes can add up. 10 missed change orders, worth $2,500 each represent $25,000 of lost revenue. Your financial roadmap should include a clear change order process. The additional work should be documented, priced, approved, and billed before the work is completed whenever possible. Protecting profit is not only about reducing expenses, it is also about making sure the company is paid for every service it provides. Overhead expenses are necessary, but they must be monitored. Common overhead expenses include office payroll, software, rent, insurance, vehicles, marketing, professional fees, and administrative cost. The goal is not to eliminate every expense. The goal is to understand whether each expense supports the company's growth and profitability. For example, a software subscription costing $500 per month may appear expensive. But if that software improves project management, reduces billing delays, and saves 30 hours of administrative work each month, it may be a valuable investment. On the other hand, five unused software subscriptions costing a combined $1,500 per month may represent $18,000 of unnecessary annual expense. Every recurring expense should have a clear purpose. Successful construction companies do not manage finances only by looking at last month's reports. They also look forward. A financial forecast may estimate expected revenue, direct project cost, payroll requirements, material purchases, subcontractor payments, equipment purchases, loan payments, tax obligations, and available cash. For example, your reports may show $300,000 in the bank today. That may look strong, but if you have $150,000 of payroll and subcontractor payments, $75,000 of material invoices, and a $50,000 tax payment coming due, your available cash is much lower than it appears. Forecasting helps the owner prepare for financial obligations before they become emergencies. After assessing the business, identifying financial problems, and setting goals, we create a customized action plan. The roadmap may include actions for the next 30 days, 90 days, 6 months, and 12 months. The first 30 days may focus on cleaning up the books, reconciling accounts, reviewing receivables, and correcting job costing. The next 90 days may focus on improving pricing, updating billing procedures, and reducing unnecessary expenses. The 6-month plan may focus on building cash reserves, improving project margins, and strengthening financial reporting. The 12-month plan may include expansion, equipment purchases, new locations, additional crews, or debt reduction. The roadmap turns financial information into clear decisions and actions. As a construction business owner, you should not have to make every financial decision alone. A CFO advisor helps you understand the story behind the numbers. Instead of only asking how much profit did we make, we ask which projects produce the strongest margins, which customers are slow to pay, which expenses are increasing. Can the company afford another employee? Should you purchase or lease equipment? How much cash should be reserved for taxes? Is the company financially ready to expand? Imagine that better pricing adds $30,000 in annual profit. Improved, improve, Improved change order billing adds another $25,000. Reducing unnecessary overhead saves $18,000. Better job costing prevents a $40,000 project loss. Together, those improvements could create more than $100,000 in additional financial value. That is the power of making the right decisions at the right time. Your construction business financial success will not happen by accident. It requires accurate financial information, clear goals, strong job costing, profitable pricing, disciplined cash flow management, and consistent financial planning. You may already have a successful construction company, but there may be hidden opportunities inside your financial records that could improve your profitability and give you greater peace of mind. During our profit and cash flow analysis, we will examine your construction business's financial situation, identify areas for improvement, and create a customized roadmap based on your goals. Our goal is to help you to improve cash flow, strengthen profitability, and potentially add $25,000, $200,000, or more to your bottom line each year. You work hard to build projects for your customers. Let us help you build a stronger financial future for your construction business. Thank you for joining me today. Please visit Elite Accurate Ledger or Nilesha Financial Services to schedule your complimentary consultation. Let's build your roadmap to financial success together. Thank you. Have a great day.